This problem, we've got 3 years worth of balance sheet information, 2 years worth of income statement information, and we're supposed to compute 3 ratios. We'll start with the return on common stockholders' equity for 2012 and 2011, and we've got 35,901, which is our net income for 2012, and we're going to divide that by the average stockholders' equity for 2012, which in this case would be the 315,791, which will be the common stock plus retained earnings for that year. Add them together, and that's the 315,791. That's the ending common stockholders' equity. We're going to add to that the ending 2011 common stockholders' equity, which would be the 162.5 and the 122,066, which gives us a total of 284,556. That's also considered the beginning of 2012. So to get the average for 2012, add the two together and then divide by 2. Take that number and divide it into the net income for 2012 to get a return on common stockholders' equity of 12%. Let's see how that compares to 2011. 2011 will be the net income for 2011, which is 33,431, divided by the average common stockholders' equity for 2011, and we'll start with the ending equity, which is 162.5 for common stock, retained earnings 122,056 rather. Add the two together, you get 284,556. And you can also take the ending 2010 common stockholders' equity, which is 162.5 and 93,459. It's the same as the beginning of 2011. So you have the beginning of 2011, the end of 2011, add them together, divide by 2, then divide that into the 2011 net income, and you get return on common stockholders' equity for 2011 is 12.4%. So it looks like these are pretty close, although the trend is going down a little bit. Let's look at price-earnings ratio. Price-earnings ratio for 2012 will be the price of the stock, which they had to tell you in this problem was $28. That was at during 2012, and it doesn't look like I've got it listed here. Let's see, do I have it anywhere in here? No, I guess I don't, but it's somewhere in your problem. It has to be told to you. So you take that price and you divide it by the earnings per share, and this gives you how many times the possible buyers of this stock are willing to pay for the earnings. In this case, it's 12.7 times the earnings. Now, as this PE ratio goes up, then it looks like more and more people are expecting this company's earnings to go higher. If it's going down, it's just the reverse is true. So it's 12.7 times in 2012. Let's see what it's going to be in 2011. 2011, the stock price was $26, and again, it doesn't look like it's showing anywhere on here that I can see offhand, but it's got to be showing in your problem. So you'll take that $26 price, divide it by, in 2011, divide it by the $2.06 earnings per share in 2011. In this case, you get 12.6 PE ratio. So it looks like the PE ratio is pretty much the same for both years. Now, the third ratio is dividend yield. Let's take a look and see what that's going to be. The dividend yield in 2012 will be the 22-cent dividend per share, and again that has to be given to you somewhere, divided by the price of the stock, which was $28, and it looks like that's going to be 0.8% for 2012, and again that dividend per share has to be something that's given to you somewhere. And then for 2011 we've got 11 cents was dividend per share divided by the price of the stock in 2011, which was $26, and that is going to be, looks like 0.4%. So its dividend yield's gotten higher, gone up from 2011 to 2012.